Thank you for joining me. Today I want to go over what is COGS or core or cost of goods sold or cost of revenue. Now the reason I kind of lump them together is you generally only get one or the other and not both. And like with Tesla, you get cost of goods sold because they're producing a lot of stuff. And with Facebook, for example, or Amazon, you get cost of revenue because they don't produce stuff, they just sell stuff. So COGS stands for cost of goods sold, which means that in the financials, you have the total revenue of the business, and then you have the cost of goods sold or cost of revenue, depending on the business. To kind of put this into perspective and to subtract the cost of goods sold from the revenue to get the gross profit. So, cost of goods sold includes the cost of raw materials, which means for, again, Tesla or Ford, the steel that goes into the production and all the little parts they have to buy, like steering wheels, airbags, all that. So, cost of raw materials, then there's the cost of labor, and there's the cost of production. So the factories all have a certain cost and a certain overhead, and then there's the labor. So you're paying for people to produce the goods. You do not include the cost of the people in management or in other departments. You only include the people that are actually producing the goods. So you have cost of goods sold, which includes all the materials, the labor, the production, the factory overhead, and all that. And that is your cost of goods sold. Now, the cost of revenue includes cost of goods sold in cases where you do have both, or rather in companies that produce things but also have a statement of cost of revenue. So cost of goods sold are included, and then you have the cost of marketing. So all the things that you have to do to sell whatever you're selling, and then you also have the cost of distribution, which means take Amazon for example. All the goods that they're selling, they need to be shipped somewhere, they need to be sent to the customer, and all that is included in the cost of revenue. So, COGS or core, both good things to look at. Are they growing? Are they shrinking? Are they growing in relation to the revenue, or are they shrinking in relation to the revenue? And those things actually are a big factor in whether or not you can predict the long-term earnings of a company. If the cost of goods sold is increasing far faster than the revenue, then obviously there would be a time when the gross profit is negative. And if the cost of goods sold is not growing as fast as the revenue, then obviously the company is getting more and more profitable over time. Now, I would want to have the past 3 years of the financial statements to kind of make that distinction and make a judgment about that. But if the general trend is there, you need to figure out where it's going, and that could be a big factor in whether or not you want to invest in a company. So make sure to subscribe if you want more videos like that. I'm posting every day before market open. Hope you have a successful day.